Hello and welcome to this Stockbox interview with Matt Logfran, the CEO of Nostra Terra Oil and Gas. Hi, Matt. Thank you for joining us.
Great. Thanks for having me.
Yeah, no problem. So I understand that Nostra Terra, during the current quarter, you have acquired an oil-producing asset in South Texas, the Caballos Creek oil field. You've also progressed drilling plans for a new well at your Pine Mills oil field, and that's in East Texas. And you've also signed a farming agreement with a new oil-producing asset in the Permian Basin, which is in West Texas. So very Texas themed, but this is the first time that we're speaking. And I wonder, before we get on to the news that you released about the money that you've raised recently, could you perhaps talk a little bit about each project? Tell us why you feel it fits with Nostra Terra's game plan and the roadmap going forward. So could we start with Caballos?
Sure. Yeah. Caballos Creek is South Texas. It's, with our other assets in Pine Mills in East Texas and the Permian Basin assets over in the West Texas, Caballos Creek adds a third asset in the portfolio, a third distinct area of operation, separate from the others. The assets are similar across the board in the sense that all of our assets are going to be shallow, conventional oil, predominant oil. There will be some gas, but shallow, conventional oil. And it's key, and it's important to point that out because typically what you hear about and what tends to take the press are the companies that are the shale players in the deeper horizontal wells, much more expensive, hyperbolic decline curves, et cetera. And we've intentionally avoided that. We've stayed away from that. We want the shallow conventional. They're less expensive to deal with, but more importantly, they have steady decline curves, not hyperbolic. So they're very steady, long life reserves, easier to work on, easier to drill new wells, et cetera. And so that's what we're focused on, is building that steady foundation underneath us to support us.
Okay, and that's what you reckon you have at Caballos?
Yeah, definitely. Caballos Creek, again, it is shallow. It's not as shallow as the West Texas, but it's shallower than it is over in East Texas, and they're all relatively shallow. It is something that we've got production that's spread across 6 different wells and spread pretty evenly across those, with disposal capacity on 2 sets of 3 different wells. Everything's set up there in a very nice way, and the operation runs pretty smoothly. The downtime for the operation in storms and such is not a big issue there, and it's just a very steady operation. Now, when we bought it, what we're looking at is 30 barrels a day gross to the company. We own 100% working interest of that, and we were able to buy it. The PV10 value of it is over $1 million. On a PV10, we were able to buy it at less than half that, $425,000. So, a significant discount for the value of its producing asset.
Okay, good. And the Pine Mills project, then, what's that about?
Well, Pine Mills is one that we bought a couple years ago. Reached payback on that, by the way, already. So everything we invest in Pine Mills, we've gotten return on. And it still continues to produce solidly. We have additional acreage that hasn't been developed on the asset, and of our couple thousand plus acres that we have that we own 100% of, we were approached by multiple companies. Frankly, one of them that we signed an agreement with, Cypress, to do a farm out for the 80 acres. So just 80 acres of the couple thousand acres, and of those 80 acres, they're agreeing to drill a well where we're going to get a 25% carried interest, meaning we don't pay for that. But then we also have a right to participate for another 10% at cost. And of course, the 10% goes into that carry. So effectively it's 7.5%, but it's at cost. So they, part of why they are attracted to it, why Cypress likes it, and why we like working with them, we're initially it's based off of seismic. They have seismic over the area. And that's where they high graded the opportunity to say, this is where we want to drill. And they believe that they're going to be drilling higher up on the structure than some neighboring wells, and an area that's been untapped. And so we think there's going to be some good potential on that. So we're carried on that first well. There's potential to drill several wells there, but we're carried on that first well and continue to have our our 32.5% interest in the rest of the 80 acres with them.
Okay, good. And finally, then on the farming at Permian Basin, can you tell us about that? I understand it's in one of the premier oil and gas producing regions in the world.
Yeah, I mean the Permian is very exciting. It's the thing about the Permian is there's stacked pay. So if you kind of picture pancakes, and that's what we picture. That's what we tend to eat for breakfast. I know it's not the case in the UK, but you know what a pancake is anyway.
Absolutely, yeah.
So if you picture that where you have these stacked pay with all these different formations, and within these, each of these formations, so many of them are very strong producing reservoirs. And so it's very neat where the different areas that you go into and within the Permian Basin, there's a lot of activity, a lot of different formations, and you can drill the same formations, or excuse me, different formations from the same well, the same pad if you want. But where we are, we're over on the eastern shelf of the Permian Basin, and again, you have a lot of the activity there. That's going to be the horizontal wells, these big horizontal wells. And we've, again, intentionally stayed away from that where we're on the shallow conventional oil. It is prone to horizontal drilling, we believe, in this area as well. And there are others that are doing horizontal drilling. But we're just working in an area that currently has only been drilled on vertical wells, conventional shallow oil. And what we've done is we actually, again, few years ago, we made 3 different acquisitions in the area. And when you're in the U.S., you have leases, not licenses. When you have these leases, they tend to expire after so many years, whether you've negotiated for a 3-year lease or 5-year lease or whatever that is. You need to drill within that period, or that lease goes back to the mineral owner. And if you do drill, though, and if you are producing, then that lease is now yours in perpetuity. It doesn't expire ever, as long as you continue to produce and pay the royalty. And so what we did in our first 3 acquisitions in the area, we bought our interest in these leases based off of low oil prices and the low production. So we were able to get in at a very low price. But what we were doing is we were banking any of the upside, the additional wells that could be drilled, behind pipe pay, whatever it is. We were banking that we could do our work whatever timing we want, no clock ticking on us. So we're buying those on the cheap to be able to do that. This one is similar to that. And again, when we did those first 3 acquisitions, the third of the 3 was 3.5 barrels a day, I think it was. And I was approached by people saying, well, 3.5 barrels a day, what's that? That's not exciting at all. Why is it even in an RNS for that matter? But what you end up having, again, is that you've got these banked, these behind pipe, et cetera, reserves that you can tap later. And in that third acquisition, we drilled the twin well, and that twin well hit payback in less than a year. Now, that's not an easy thing to do, to find wells that are going to pay back in less than a year, especially under $100 oil prices. And we strong oil price during that time, just where we are now, and again, paid back in a year. So very, very strong opportunity there. And what we've done now is we've levered our way into this same area. This particular acquisition or farm-in is 6 miles away from the twin well. So we're in that same area. We've got 3 different wells that are completion or recompletion opportunities. And our farm-in, what we're doing is we're going into an existing well that was already drilled. It was drilled back in 2008 when oil prices were at a high. And if you go back and look at it, they were screaming high and dropped like a rock. It went from $140 a barrel down to $40 a barrel. And at that time, those are kind of crunching numbers to where the company ended up having to leave the asset behind. And so that well was drilled, never completed. Not that it was completed in different zones or whatever, it was never completed. So we're going to go back into that well and we're going to complete it in the same formation that the twin well was completed in. And now we've gone in for the reentry cost and the completion cost, but we don't have the drilling cost. That's a sunk cost already. And us completing that and doing that well is our farming cost, where we will have revenue from that well. Provided successful, we'll have our share of revenue from that well. And then we still have an option to acquire the rest of the asset and increase our interest up to 75%, where there's additional opportunities. So it's a nice way to lever our way into something that could be potentially very strong for the company.
Okay, good. And did you say the lease then? Did you lock the price of the lease in at the start?
So the terms of the lease with what you pay to the royalty owner, that's already set. It's been set for since back when the leases were signed originally.
Hmm.
So what we've done though is those leases are already held in perpetuity by the handful of barrels a day right now that you've got.
Mm-hmm.
So that allows us to come in and we what we're doing in the farm end is that first well we're going to complete it. We have the option to acquire the rest of the assets, our interest in that, and at that point we can go after other wells right away, or we can sit on it for a decade or more and do nothing, and just produce out the wells that we've got. So you got all sorts of optionality there. The way we structured the deal, the way the leases are intact, etc. Lots of optionality there.
Okay, and you've got the scalable upside as well depending on what oil prices do.
Yeah, yeah. I mean, there's three obvious opportunities right there. One being the completion, and the other two being recompletion.
Hmm.
And then there's other wells that we can do a little bit of work on, some workovers. And then there's some PUDs, some locations that we can drill new wells on as in addition to that.
Okay, and on the sort of price of oil then and the demand, where do you see that sitting now and going in the future?
Well, I mean, you can argue a handful of different things. I'll tell you my point on it, and I'll tell you why I don't care at the same time, because I think they're
Hmm.
both important. Um, there's a case to be made, I believe, if you look at the last downturn in 2015-ish, around there, where you had a lot of the majors and super majors that were cutting out some of these big projects, and they were cutting those out, not moving on them. If you decide that you change your mind, you want to do something, you've probably got about a 5-year lead time before you can get those moving again and get to the point where you're producing. So the pipeline, as far as filling, with projects and replacing reserves and replacing production, has slowed down at that point. Now, at that time, though, you had a lot of money that was going into the Permian Basin, specifically into these shale plays, and there's a lot of money that went into those. But in the last year, prior to the current downturn, that capital, that market, that spigot had been shut off. So now you have the current downturn, what's hit, and you don't have the pipeline being filled anymore. So it wasn't being filled in 15, it's not being filled now. If oil comes back to 60, you're still looking at a lot of oil companies with shell assets going under. It's a record number right now. They're going to continue to be that way, I believe, up to $60 oil still. So I don't see that money coming back into that market either. So all in all, I actually think we could be setting up for a mini boom in oil prices in call it 12 to 18 months.
Hmm.
Um, but the other point I wanted to make was, aside from what may or may not happen with oil prices, the way we run the company and what we're doing, we're not making investments based off of any potential of that to happen. What we're doing is we're looking at assets that have low operating costs that we can run and make money at lower oil prices. So
Hmm.
our drive as a company at a whole right now, our main drive is getting to the point that we're cash flow positive at the PLC level at the lower oil prices. So
Okay.
we're targeting getting there at $30 oil. We're around 40 right now, but that where oil is trading. But we want to continue to build that up, so we're still even comfortable at $30 oil.
Hmm.
But our lifting costs on our assets are in the low 20s to the high teens. So that's where we're positioned. If oil goes to 50 to 100 to whatever it is, that's great. All the better for us. But if it doesn't, we're protected in that sense.
I see.
Um, something that some of the investors are aware of, back in November of 2019, last November, we hedged 60% of our production at that time at $55 to $57 a barrel for all of 2020. So when the downturn hit in March, April, etc., we're guaranteed to get $55 to $57 a barrel all the way through the end of this year.
Hmm.
We're protected like that. We'll continue to hedge and protect ourselves, so our investors know that we've got those, the basics covered, and the assets producing at the low oil prices. Those are the kind of things that we focus on. But we're positioning ourselves that if oil goes higher, we're still going to turn out very well and have lots of upside from there, some opportunity, etc.
Okay, good. Thank you. Good answer. And finally, then, just touching on the recent news of you raised $500,000. How do you plan to deploy these funds?
Well, the farm-in that we did in the Permian Basin is the main target there. In addition to that, the Pine Mills, the Cypress well that we talked about, we have the 25% working interest that were carried, the other 10% that were not. So it covers that well also. The Caballos Creek asset, that's funded. We've taken care of that. That one we actually acquired 100% working interest, all that asset with financing, non-dilutive financing, 100% of that non-dilutive. So that was a nice acquisition to be able to pull that off, plus the financing, cash flow still, debt service, et cetera. It's a very nice addition to have. So we don't have to have any capital for that. However, we're currently going through and we're doing a review, a geological, and having our engineering involved to where we're looking for behind pipe opportunity on that, as well as other undeveloped reserves. So it could end up going for there as well. But the main areas are going to be the farm-in on Permian Basin, the coming up well on the Pine Mills, and then additional opportunities.
Okay, great. Well, Matt Logfran, the CEO of Nostra Terra Oil and Gas, thank you very much for talking to us.
Great, thank you.
Thank you for listening to this Stockbox interview. For more information, interviews and videos, visit our website at stockboxmedia.com or give us a follow on Twitter by searching @StockboxMedia.